A year ago, we did our state of the market, and we've got on the screen, we had basically $34.1 trillion in debt. We did our state of the market this year. I put the same screenshot up there, $36.5 trillion. We gained $2.4 trillion in debt in a year where the economy supposedly grew.
Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. David, you're always a busy guy, but you just completed a run of, I think it was 6 consecutive days where you were on. You were in Topeka, you were in Chicago, you were speaking at events there. We had to plug you in to do one of our estate planning classes. Mike Schuettel, our usual presenter, is on a mission trip to Taiwan. And then, of course, we had the State of the Market address, 2 sessions of the tour de force State of the Market address. And oh my goodness, but you came through it with flying colors.
Yeah, and they were all different presentations. So it's one thing to do a keynote. I've got a couple of keynotes that I do and get hired to go do, but it's the same presentation, you know it, where these 6 days in a row, I literally gave 6 different presentations. The only time I repeated was on our State of the Market because we had such a big response. We had to do it 2 sessions, and man, that was fantastic. What a great venue!
The Durham Museum,
the Durham Museum, it was awesome. Yeah, the lower level. I had no idea that it was there really down there, and great venue for us. And I think Jeff Bush did a great job and was very well received with the information he brought. So fantastic event. We're certainly going to probably have to do some events there in the future.
Well, several people commented to me, David, how much they enjoyed being able to just wander the museum afterwards. Some folks had never been down, or they didn't know that there were lower levels to the museum and the exhibits and the historical artifacts and so forth. So that was great. And then the beat just keeps going on here at Retire Smart. We had another successful showing, David, of The Psychology of Retirement, the retirement movie in Lincoln. Miles Morrissey, joined by his father, Todd Morrissey, for our ABCs of Medicare class. Miles learned Medicare at the knee of his father, who is the president of Medicare Solutions at Advisors Advisors Excel Wealth Management. Thank you. In Topeka, a firm we collaborate with on numerous projects. So the beat goes on. But David, we've got a really big day coming up Monday, March 3rd. We've already been up and running in Lincoln, but we're going to have the formal grand opening of our Lincoln office. It's in the Nebraska Realty Building at 7321 Plaza Court. That's where 84th Street meets the Nebraska Parkway in South Lincoln. During the day, none other than Tom Osborne, first citizen of Lincoln, is going to stop by to welcome us to Lincoln. Then at 4 o'clock, David, is the big ribbon cutting with the Chamber of Commerce. Des Moines Adams, the executive director of Teammates, who looks like he could still play rush end for the Black Shirts, he's going to join us at 4. There's a reason for the Teammates presence on March 3rd, David. Why don't you tell the folks about it?
Well, we've always supported Teammates for years. We've been a donating partner with them, but we're stepping it up this year. So we just signed for the next 3 years to be the title sponsor of their annual golf tournament, which is a key fundraising event for them to allow them to do the great mentorship that they do. And by the way, if you're out there and would like to consider being a mentor of a young man, they need mentors desperately now. They have so many kids that are ready and looking for help. So you can go to their website and check it out. But yeah, it's a great organization. We're really excited to partner with them.
4 o'clock, that's the ribbon cutting on Monday, March 3rd. If you want to join us, the Nebraska Realty Building is at 7321 Plaza Court in Lincoln. All right, into the news we go, David. I want to hit you with 2 tax stories. The first one is, this actually came from the House Ways and Means Committee, wanting to make sure the record is set straight. In fact, the headline is Correcting the Record. And in quotation marks, it says, Trump tax cuts only benefit the wealthy. Well, the purpose of the charts and the data passed out by Ways and Means is that is not true. That is not so. The Trump tax cuts actually benefited some of the lower classes, the lower strata of income, even more percentage-wise than it did the top levels.
Yeah, and we actually have it on the screen, and basically the lower income people got a bigger tax cut, almost 13.5% on average. Then the next income level got almost 12%, then 10%, and those that are making over $1 million a year, taxes certainly were cut with everybody else's, but they only got about a 5.9% cut in their tax bill. In fact, the top 10% and the top 1% that we always talk about, right? they're actually paying more of the total tax bill now than they ever did before.
The top 1%, almost half, 45%. And if you stretch it to the top 10%, that's 3/4 of all the income taxes paid there.
Yeah, and so the top 10%, that's what I like to focus on because that's where the productivity happens in America. That's just reality, right? And they were paying 70% of the freight for every tax liability in America prior to the Tax and Job Act of 2017. They are now paying almost 76%. So they've picked up another 7% basically of the freight, so to speak. So this idea that if they extend the tax cuts, right? And I like the gentleman from Idaho, I forget his name right now, representative, who's like, look, all they're trying to do, and there was all this hubbub on X or Twitter this week from every Democrat got the same talking point. Oh, they're gutting Medicaid. They're sending you out to pasture and SNAP. No, all they did was, can we keep the same tax bill? In fact, inside the resolution they passed, we want to tax billionaires on what's called carry interest. Hedge funds, this is one of the tax breaks they've been getting unfairly. In fact, Jeff Bush talked about this at the State of the Market. So this actually would put more of a burden on the higher end, not less. And you need to understand, it's a $4.5 trillion tax hike on American society if we don't get it passed. That's what's going to happen over the next 10 years, which means that comes directly out of productivity and our GDP, right? So that'd be a pretty deep recession.
There are two persistent criticisms of tax cuts. One is this, they only benefit the wealthy. Well, as this data shows, that is not true, objectively speaking, factually speaking. The other one is, you're going to bankrupt government. Well, David, you sent me this story from Fox Business quoting Larry Kudlow, reminding his message is Republicans must stick to the Laffer curve. Remind us again about Art Laffer and his curve regarding taxation and revenue, David, and then we'll go from there.
Yeah, and he's actually helping out the current Trump administration, but Laffer kind of came to prominence in Reagan's administration, all the way back in the very early 80s, understanding there's a point of what we call diminishing returns. You can raise tax rates and raise revenue. But if you raise that too far, you get diminishing returns. In other words, you cut growth and productivity, so there's less of a pie of revenue for you to get your percentage of. And in corporate tax rates in particular, that's where we just got insanely out of whack with the rest of the world. Again, it's all got to be relative because it's a global economy, Chip. So we had tax rates in this country at 35% for a while. Trump cut them all the way down to 21%.
Talking about the corporate
tax rate.
Yeah.
Correct. The corporate tax rate and international competition. And that still didn't put us average of the rest of the developed world. The G20, the average tax rate of the G20 is about 18%. So the biggest 20 global economies.
But at least we were in the same ballpark.
But with deductions, credits, and incentives in there, we were down about 19.8. So slightly worse than average. But we've increased the amount of revenue that the government collects from corporate tax rates, which is not a big piece of the overall collection, right? And people need to understand this, but it's fun to talk about these evil corporations. Bernie Sanders loves to talk about that. We've doubled the revenue collected in 7 years, doubled it in 7 years. That is a path forward, a path for success. And so that's what Kudlow is talking about, is you need to understand the basic economics. But again, we have the average American reads at a 6th grade level, Chip. That study just came out. That's the sad reality. So you can one-line them on social media and get people to follow along with the herd, so to speak, and it's just not grounded in reality. Data tells the story, and we don't care about the party or the politician themselves. We certainly have our own opinions, but we care about the policy, and that's all we try to do is interpret the policy and then help our clients make sure they're making the right decisions based on what that policy means for them now and in the future. And boy, in 2025, it's going to be a really important year to make sure whoever you're working with has that type of planning system in place, because there's a lot of potential changes here coming and a lot of battles still to fight here within Congress's halls.
If you want a healthy revenue stream for the federal government, lower taxes actually increase revenue.
I mean, we proved it immediately. Tax receipts went up almost 22% the first year that the Job Act was in place. And they were record until COVID hit. And that was what we call a black swan event that no one really could have modeled or predicted.
David, let me combine two stories that involve Jamie Dimon of J.P. Morgan Chase. We quote him often on this show. And he has been outspoken on two topics where I think he matches up with you. The first one is, you were on this right from the start of the pandemic, David. The headline from Forbes is, Jamie Dimon is right. Remote work is a waste of time and talent. I don't know if there's much more to say than that, but you've been on this, as I say, since the beginning of the pandemic.
Absolutely. And his rant, by the way, if you want to, there's a few naughty words in there, but it's pretty easy to find. If you Google or go on social media, you can find the rant that was caught on tape and released. But he's tired of this nonsense. And where it really harms employees is new employees, right? And you may think, oh, I got this great job, it's remote. Well, you're out of sight, out of mind. So when job cuts come, and guess what, Chip? In February, we already have more job cuts than we've had in the last 22 months. So it's the highest month already, and it's not over as we sit here recording this. So we got over 130,000 job cuts in February already, and that's not including the government, which is going to have about 200,000. So we are seeing the job market change right before our eyes. And if you want to be employed, you might want to rethink if you're actually going to be one of these hybrid employees. You might want to show your face around the office, even if they let you work at home, because if they get to where they cut, they're going to cut out of mind. I'm just telling you. But the reality is the innovation. I talk about the water cooler innovation that gets lost, but the young employees completely get lost. They don't know the culture of the company. They don't understand, and they're not being mentored properly. They're just stuck at home trying to knock out a project. They don't know who to ask for help. When you're in an environment like in our office, we have 20,000 square feet here in our main facility. We have other locations now, but in this office, you can walk to a cubicle and ask somebody senior to you, hey, I'm struggling with XYZ, and someone's there to solve it immediately. That doesn't happen with remote workers, and the productivity is falling off a cliff. Now, certainly, there's a few exceptions. A senior employee that's, maybe reviewing, code or reading drafts of contracts, but doesn't need to interact, but they've already been trained in the culture and senior, maybe that hybrid works out. But for most workplaces, you're going to see a full demand to return to work. And we're seeing this with all the big tech companies now. And of course, we're seeing it with the federal government, and that's shaking out a lot of leaves are falling off that tree currently.
We're only going to give you about 30 seconds for this one, David, but I just wanted to note, Jamie Dimon also made news by sounding off on DOGE, the Department of Government Efficiency. There's been some heartburn in some circles about DOGE's activities. Jamie Dimon, this is from CNBC, Jamie Dimon calls U.S. government inefficient and says Elon Musk's DOGE effort needs to be done. My understanding, David, is he's not really what you'd call a doctrinaire conservative politically. He's a businessman who's been looking at the bottom line for a long time of government and saying, this isn't making sense.
No, and if we're going to move forward, the economy, we got to trim the size of government. It crushes growth of the GDP, and we need to cut government by, realistically, we could probably cut our government by 60 or 70%. Now, that's probably not happening, but that's what at least the numbers from the outside look at. How many departments have waste and fraud? Now, there's two separate issues there. There's waste and there's outright fraud, and both are happening. Waste, I think, is a much bigger problem than fraud. Certainly, there's some fraud in there, but just the waste and the amount of work that needs to get done, and then people are like, hey, Chip, this is nuts. Some guy who's not elected demand me tell him 5 things I did last week. Well, we happen to have a consultant in our office right now that I pay who's outside, and he puts some demands on you guys. What have you accomplished, right? The exact same thing. We pay, I from the top, hire a consultant to come in and help me make sure my company is running in max efficiency.
The head of the executive branch has brought in a consultant. I think he's doing it on a volunteer basis.
Yeah, he's not even taking any pay, right?
So
and he's the wealthiest guy in the world, so he doesn't need the money. And he's going to enrich himself, just like Trump, he's losing a lot of money, the value of his stock, and people are, anyway, it's nuts. We've got to get this right, and you're going to break a few eggs going through this process, making this cake, but you got to probably cut 20% past where you really need to, and then you hire back for what's really needed. And the other big thing I think that's going to come out of this, hopefully, is we're going to break up. We have over 430 government agencies, Chip, but we need to get that down to about a dozen, and then we need to move them to major cities around the country. They do not need to be headquartered in Washington, D.C.
Up next, digital currency, cryptocurrency. It's not going away. You need to be informed about it. Stay tuned for the latest news in digital assets from Retire Smart financial advisor Brad Starkin. He joins us next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. As part of our continuing effort to inform and educate our clients and the general public on all manner of topics related to retirement, we bring you another conversation with our resident authority on digital assets. David, please welcome our special guest, financial advisor Brad Starkin.
Thank you, Chip. Yeah, once again in the studio in relaxed form today. We both have golf shirts on for various reasons. But anyway, we are talking with Brad Starkin, one of our advisors who's kind of our digital asset guru, if you will. You actually have certification in this area. And we have a class that's become quite popular again. What do we even call this class on cryptocurrencies and digital assets?
Yeah, so it's our digital asset class that we're going to be having. It's on March 4th at 6:30, and really just starting to go through kind of the cryptocurrency, digital assets, kind of 101, if you will, just really starting to dip our toe in to help a lot of our clients and even prospective clients to learn a little bit more about the space. I know it's on a lot of people's radars.
Oh, absolutely. I mean, you and I have joked, and again, we do have a very small allocation for a portion of our clients through a legalized way of buying this, at least under the SEC's purview, and that's through exchange-traded funds. You did the research with me on those that we've utilized, but we're seeing more of those come to market, and I don't think that's going to slow down anytime, right?
Yeah, I certainly think that's going to continue to increase. Certainly something in this space that we are looking for is more regulation, right? And just security on the back end for a lot of things.
Well, ironically, I think we just had our state of the market update, for all of our clients. And thank you again to everybody that turned out. We had about 500 people come out to the Durham Museum last week. And but one of the things I talked about is one of the biggest thematic things I think investing is around cybersecurity, because quantum computing, AI, and blockchain technology, right? You're going to want to layer these new types of technology into the security or infrastructure security, banking, insurance industry, the way we cloud store our information, et cetera. So I think you're right on the money of security. Speaking though of security here, I see that, is it Bybit? And are they exchange? Are they, they're basically a crypto exchange.
Correct.
They were wiped out, right? I mean, like $1.5 billion was stolen by North Korea. Is that right?
North Korea, yeah. So I mean, it's crazy, and it wasn't that there was either like a glitch. It was Ethereum that was taken out, and among some other coins, but ultimately it was some of their cold wallet storage, actually.
Yeah, and so this wasn't a hack. This was not a hack. This was basically social engineering, as I understand it, right? They kind of did some transactions, got to know who was approving on the other side, and somehow slipped a line of code in that when the person approved the transaction, basically opened up their entire vault, if you will, right? They had the keys
which is
to the
offline.
Vault. Yeah, and so offline went in and raided this vault with over $1 billion. Now, do we know if the customers of this storage facility, Bybit, did they get made whole, or is that still up in the air? Do we know?
I believe that's still up in the air. To my knowledge, Bybit has bought back those Ethereum positions, but more to come on that story, which this is the largest hack in that space. Now, granted, a couple of years back, you certainly had the just absolute blatant fraud with FTX, and they were using your money illegally in the background, kind of almost like Bernie Madoff, if you will. But this is entirely different. And, you'll probably continue to see things in this space around that. That's where the regulation needs to come from. And, certainly with this new administration, they're very pro, digital assets and cryptocurrency. So I'm curious to see what the future holds.
Well, I do believe that you're going to see a massive uptick in the use of these technologies, blockchain in particular. And we've talked about on the show in the past, like Bitcoin is kind of the one everybody knows, but that's really just a relative store of value, right? Either a replacement for currency or a replacement or for a digital version of gold, as some would say it.
Correct.
And again, I'm not here arguing one way or the other how you look at it, but there's a limited quantity, and about 90% has already been mined of whatever's possible, right? 21 million or something like that.
Correct. So the coding on that is there will only be 21 million Bitcoin ever mined in the history of the coding and the transactions, and just over 19 million have been mined up until this point.
And about 10% of that has been just lost forever, right? Or supposedly.
Somewhere in that range. No one knows for sure, but somewhere in that 5 to 10% range of anything that's been mined already. Just because when this initially came out, over a decade ago, it was, a couple cents. So people had them and it wasn't really worth anything at that time. And it's just appreciated through the last 10 to 15 years.
Well, so let's talk about, because I have a good friend that that had, I think, 4 Bitcoin when they were worth like $40 each, and basically stored on a thumb drive, right?
Yep.
Not an encrypted thumb, just a thumb drive, and misplaced the thumb drive. And at the time, out a couple $100. But if they were to find this thumb drive maybe in their home, which they think it still might be, that's $400,000, right?
That's right. So that's with that individual that we both know, along with, there's many other people that are out there that have that very same story. So that's why these are just gone, or people may have passed away with their private keys that weren't passed on to their loved ones and things of that nature.
You help me understand, because I have on 2 exchanges like Coinbase. I have an account on Coinbase. That's the kind of the, I guess, most widely known reputable one here in the U.S. But I do it to buy and sell if I'm doing it very short term. But I have digital assets, and you've helped coach me on a few things I've purchased that I want to store. I bought my own cold storage wallet, right? Correct. An encrypted wallet, but I have to leave detailed instructions to my wife, which I have in a safe, of how to get into said assets, right?
And it says, see Brad.
Yeah, exactly. Well, she has instructions for everything. So see Mike about this, see Colin about this, see Brad about this, talk to Sean about that. So my wife's always like, what do I do? I said, just go to the office. They know. They know if something happens to me. So, but I mean, seriously, this is really important for people that are going to think about, if you're going to use this as the store of value, right? And there's various coins. Again, I'm not a big fan of the meme coins, which are, that's kind of a real swap and rip off somebody. Hey, I'm going to make this whatever dog on a coin or whatever, or hawk to whatever, But the serious ones are having a massive uptick in usage, right? Again, Bitcoin is more the store of value, but your Ethereum Smart Fi contracts, Solana is going to be used. I think Solana, is that how you pronounce it? That's going to be used a lot in the stablecoin space, right?
Yeah, I think just the technology behind everything is just fascinating, and I think that's just really taking just everything into the new age, right? So I just was reading an article the other day talking about how we get paid for folks, every 2 weeks or maybe once a month for some folks. And the reason behind that is the cost behind everything.
The cost of the accounting. No, absolutely. Every time I run payroll, I have to pay the payroll service a fee and then a per check fee.
Yes.
So in other words, actually I had one of the employees, well, why don't you pay weekly? Well, that would double my payroll costs. Actually, I more than double them.
Yeah. So, I mean, just interestingly enough, if you were able to make these, transactions for 3 to 5 cents, I mean, there was someone that argued, in theory, you could probably even get paid every day from an accountability standpoint.
There's actually a convenience store now doing that using some technology, and they're widely known in this area, have some pretty good pizza. But anyway, so I think you're right on the money. That is going to change, and that's why I think there's going to be now again, these stable value coins are not necessarily going to be these speculative high and rises, but they're going to be backed by currencies of various governments, including U.S. treasuries, right? So
Correct.
These stable value coins are going to have a place in that cross-border transaction. International companies, somebody doing consulting work in Mexico, Canada, you can make the transaction, get paid digitally, instantaneously, versus waiting for ship it to the home office, net 21 days payable, then the accounting team takes a month to record it. I mean, I know now we switched accounting teams for our company about 1.5 years ago because I got tired of waiting 30 days for my P&L and my balance sheet. I'm like, man, I'm moving at the speed of business. I can't make decisions a month or 2 months behind on my numbers. I need to know where we are. And so now we have accounting that I get updated every day. And it's the same thing. You're saying transactions would be the speed of light, literally. And so you could get paid every day.
And for pennies on the dollar too, of moving it. I mean, you're talking folks that could move, hundreds of thousands, not millions of dollars for 10 to 15 cents, which would be a big game changer for a lot of companies' bottom lines as well.
You're not kidding. The accounting world would be flipped on its head, but in a good way. The productivity would increase, the expense would go down. I think that's fantastic. So you're going to kind of cover the basis of the different type of coins, how and where it's utilized, what the speculation piece is, but where you may see it utilized in your future. All this and more is covered in your digital asset class. Tell everybody again when that's coming up because we're running out of time.
Yes, that'll be on March 4th at 6:30 p.m. here at the Midwest Learning Center at our office.
All right, but you do have to register. So go to our website, retiresmartnow.com. Go to the events page and register or call the office. Thank you so much, Brad, for stepping in the studio this week.
Yeah, thank you for having me.
All right, Chip, what do we have next?
Up next, you have questions? David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go. David, the next few shows, we're going to be cycling through the questions that came in during the State of the Market address. Now, we're going to go over the 3 that we went over at the event. There are about 24 more. We couldn't do them all that day. But as we told folks that day, your question will not go to waste. We'll use it on the radio. So here we go. Tariffs, David. How will tariffs affect me, and when would I start to feel that change in my wallet?
Well, you're already seeing it. So you have to understand is what's happening is companies increase their CapEx expenditures the minute the election happened, knowing these tariffs were coming. They bought supplies in. Demand went up on certain supplies, and that is already coming through in the cost of things. We've seen CPI rise to over 3% in the most recent reading. And so you are seeing that immediately in a short-term effect. And so, but in the end, you're going to also see manufacturing jobs announced all throughout the U.S. We had not one, but 2 different major auto manufacturers announce new plants coming to the state of, I think, Kentucky or Tennessee. I'm trying to remember. Sorry, but they're going to manufacture stuff here, which is the intention of what Trump is trying to do, to move manufacturing jobs back to the U.S. from the Far East.
There was a lot of discussion, David, by you and Jeff Bush about the Social Security system. So not surprisingly, we got a question on Social Security. Should I consider turning on my Social Security early to avoid future changes? What changes can I expect?
And I think Jeff and I basically both had the very same answer. No, most likely. Now, there are certain circumstances, yes, it may make sense to turn it on at 62, but for about 93% of the people, when we run analysis, which we'll do for you, complimentary if you want, we actually are going to tell you to wait till at least what's called FRA age, full retirement age. The reason is there's no political will, Republicans, Democrats, the independents, to cut somebody who's already on the benefit or this close to, say, taking it. So as Jeff put it, anybody that's within 10 years of full retirement age, 57 or older, they're probably not going to change Social Security at all. Those of us that are younger than that, I turned 57 this year, so I'm right on that border. They're most likely going to have to actually make changes. But here's the thing. Social Security is signed into law in 1935, Chip. We've only made the actuarial change once. And that was in 1983 under Reagan, right? Only one time did we move the retirement age from 65 to where it is now, 67. Well, we're living significantly longer, about 6 years longer now than we did just in 1983 and 15 years longer than we did in 1935. So it makes sense to actually, hey, your full retirement age might be 69 or 70, et cetera. And it's solved, but then you're going to have the old, Ryan taking grandma off the cliff commercials from political pundits.
Yes.
But it's so simple to solve. And on top of that, as I said, no more Social Security. If you're under 18, you're not going to have Social Security. We're going to put money in an account that invests in U.S. companies, and you can access the value of that account when you're 70. And you will have way more than any of us that put money in Social Security, and it's off the government rolls. Simple.
I think Jeff Bush also mentioned that even if surpluses and trust funds and so forth, if those sources are exhausted for Social Security, it'll just transition to a pay-as-you-go program. It might be knocked down 15 or 20% the benefit, but it's never going to completely go away.
Correct. The budgeting right now shows that you'd have to take about a 17% clip to the check that you get. So they would reduce your check by 17%. And I will tell you, we actually model inside. We don't really even show this to clients. We don't want to worry unnecessarily, but we model it in most of our income planning. You're still fine. You're still going to be okay. Now, I would like you to get your full benefit. I would like you to get that tax-free if possible. Yeah. But the reality is we are going to adapt the plans for our clients when they're there. But if you are concerned seriously about that, have your advisor show you the numbers. And it's not that hard to do with the software that at least that we engage here at Retire Smart.
Well, here comes DOGE again, David, the Department of Government Efficiency. That surfaced in the presentation and in the Q&A at the State of the Market address. How will DOGE affect my Social Security and Medicare? What planning can I do to help myself?
Again, this is pretty similar. Not really going to change much for current people taking Social Security or Medicare or those that are within a handful of years of drawing it. There may be some shifts to it. Again, maybe Medicare doesn't kick in till 67 for people that are under, say, 50 years of age, et cetera. There are ways to solve all these problems with simple logic and reasoning, but that's not how a truly partisan setup in the political front we have today works. But all these problems can be solved, and that's why I think if DOGE gets to work and cuts and guts the government down, we'll be able to get down and see with transparency the budgets on these line items, et cetera. And we're currently up to about $130 billion saved, at least from the website, and you can, DOGE is on there. It's people are like, we need transparency. Go check it out. The numbers are all published where the savings are, and they've just started, Chip, just gotten started. So I believe that anybody that's within 5 to 7 years of drawing either one of these benefits, you probably have nothing to worry about or fear. But there needs to be some changes to it. And what they may do is a combination of changing the age, means testing the beneficiary, or raising the tax limit on how much we put in. And all those are probably likely to get combination put in place to fund these benefits.
So the similar refrain I hear from both of those last two questions is don't panic. Don't do anything rash.
No, and don't make a mistake of turning your benefit on early just because you are panicking and reading something on social media. It's a 30% cut for the rest of your life. I mean, and sadly, and now again, this is not normally our client, but 52% of Americans, it's basically the only income they get in retirement.
Ooh, that's not a good place to be.
No, and so listen, I don't care if you're 5 years from retirement or 15 or 30 years from retirement. Start saving. It's on you. It's your responsibility to start investing for your future, and we can help you understand how to do that. But anyway, it's a sad reality that so many people that this is their sole check, but that is the reality. And so we certainly want to we're the richest nation in the world. We have an economy that can just outdo anybody. We need to have these benefits secured in a way that at least gives us some sort of safety net, but it's got to be within reason too. We have so much abuse and waste within the system, and that's where people get really upset.
Up next, a fraud warning for investors, and then highlights from our annual State of the Market address. You're listening to Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. David, I do want to get to the highlights from the State of the Market address, but first, you sent me this item from Charles Schwab. Fraudsters targeting investors over social media. And the story talks about a pump and dump scheme. What's going on here, David?
So pump and dumps are pretty common. So what it is these so-called PR firms will call. So just so you know, this used to work in the old days. And if there's a movie, The Wolf of Wall Street, kind of what they did. These companies go public that have horrible financials. Anybody can make their company public if they want to go through but it's fractional pennies or a penny a share or something like that, to the tune literally what we call penny stocks. And then somebody goes out and starts pumping up the story. They're about to get some blah, blah, blah approved, or they've got a new whatever it is, new widget or what have you. And so they go out and they pray, and they used to call brokers and do this, or they would call investors. Hey, we're about to break loose on this and you can buy 10,000 shares. And they would pump the stock up and they would show that, hey, the stock just went from 3 cents to 8 cents. Get in now. And someone buys in a little bit and they take it up to like 20 cents and you need to put 100 grand in here. And then they move it up to like 50. And then they sell all their inventory and the stock crashes back to
the fraudsters sell at the peak,
right?
And everybody else is left holding the bag.
And they time this, and so now with social media, they're doing this regularly on social media, and so we even have clients that sometimes get baited into these things. Hey, I saw this great idea. Could you buy this? No. First of all, if it's under $5, we won't buy the stock ever. That's what we call a penny stock, and if it's traded on the pink sheets, you should. That's over the counter. That's not, the financials have not been vetted enough for that stock to trade on a reputable exchange. That should be your first warning sign. Doesn't mean you can't make money in them. I mean, but that's pure gambling in my thing. So Schwab, which is one of the 4 custodians we hold clients' assets at, has seen an uptick in this. And so they put out an investor warning. And so that's why I'd send it to you. It's just, I think it's prominent that people just, look, if it's too good to be true, it's probably too good to be true, right? By the time Wall Street finds out, Wall Street smart money knows about these things, breakthroughs, investments with venture capital. There's not going to be some guy who's in the closet in the woods in Ohio that has this new, and you can get in now, right? I mean, that's just not reality.
All right. Beware of someone generating artificial demand out there for something too good to be true. David, you sent me a headline from CNBC, and this is a segue into your State of the Market address. In fact, it was one of your slides. The CNBC headline is February Consumer Confidence Posts Biggest Drop since 2021 in latest sign of slowing economy. I thought there was lots of hoopla and optimism around Trump taking office and so forth, but the consumer confidence post and then the related expectation index, that was also down. What's going on here?
Yeah, so the consumer's worried. They can see, and just so you know, I don't have the chart this week. I should have sent it to you, but it basically shows the S&P along with what's called the JOLTS report, job openings, right? That's how many job openings are in America. And as the job openings grow, you usually see the S&P growing with it. The job openings have taken a vicious turn over the last 12 months and gone down, and the market kept going up. So
I think we talked about that in recent weeks, actually, yeah.
And so consumers are not looking very confident going out. Credit card debt is all-time high. We're back up to almost 11.9% delinquencies over 90 days on credit cards. That's pretty significant. And all this, we went through all this information at the State of the Market. We don't have time to get through all that today. But the reality is, the one thing I finished the State of the Market presentation with was CEO confidence is, in fact, up long-term because of deregulation and cutting spending and potentially lower tax rates on corporate balance sheets, et cetera. So those are confidence builders.
So the CEOs are there, but the consumers aren't there yet.
But the consumer, and that's what I mean. We're going to go through this period. We've been in a rolling recession for a while now. We've talked about that. And not a real recession, but a real recession may show up simply because the job numbers are going to continue to mount. And we've seen, like I said, in February, we've already seen more job cuts in the month of February than we've seen in the last several years. And that's probably likely to continue.
Well, let's pick it up there. Now, we can't do your whole State of the Market address, but let's give folks a taste or a slice. In fact, let's focus on, because the latter portion of your presentation focused on expectations for 2025. In fact, we've got the slide up there. What keeps David Brooks up at night? Let's start there, and with whatever time we have left, give us some highlights from the State of the Market.
Yeah, there were three primary things we talked about. We talked about tax policy, which we started the show with. We talked about inflation, right? And we talked about debt. And so let's kind of start with the inflation thing first here. So if we just had CPI reported at 3%. It was actually 3.02. And as we predicted, that was higher than the expectation. And I called it on the show a month before the number came out, and everybody on Wall Street said 2.8 to 2.9. Nope, it was higher. And if you can see the chart, if you're watching on YouTube, inflation hit its low point last September at 2.44. And the Fed said, hey, victory on inflation. We'll start cutting rates now. Well, if you got victory, wouldn't you just hold and let that be true for a little bit, hold a little longer? But they didn't just cut rates, Chip. They cut 50 basis points. And of course, there's a lot of people like me that believe, well, maybe that has something to do with politics. You know, maybe they're trying to inject some infusion in the current administration. But anyway, inflation has now gone up 5 months consecutively, and it is not finished off. And if you go back to the 80s, again, if you don't study history, you're doomed to repeat it. The same mistake was made in coming out of the Jimmy Carter years in the 1980s, and they thought they had inflation tame, and then when it roared its ugly head, it roared mightily, and that's when Paul Volcker had the guts to rip interest rates all up to 20%, crush our economy temporarily, but got inflation kind of put it to bed, and we haven't really seen it since. We've not had inflation like that in 40 years until just a few years ago, where we got as high as 9%. So again, inflation is still a major concern for me, and so that kind of helps us look forward. What else should we be concerned about? Well, one of the things we're going to follow is interest rates, because that's telling us the Fed is trying to lower interest rates, and that would certainly help the current administration, right? So if we were to look at interest rates, by the way, still here's a great visual of the dollar. So I can't see what's coming. But anyway, this is just showing you over the last 40 years what inflation did to your spending power. But here's the Fed funds rate, right? So if you go back and look through the last three cycles, you can see when they raise rates, they pause for a while, and then they start to cut them. Why does the Federal Reserve cut rates? Because the economy is now slowing down, and they're trying to juice it. They're trying to get it to pick back up. But what always happens by typically the fourth rate cut is you can see a gray line there, we are in fact in a recession. Well, where are we at right now? We've had 3 rate cuts, and now they're on pause because they're a little nervous about inflation. So what if they have to actually raise rates again? That would be kind of disastrous in the current economy. And of course, Trump is out there demanding they lower rates, right? Are they going to lower rates? Maybe. But here's the reality is the Fed controls the short end of the curve. They control the short-term rates. The market sets long-term rates. So if we go to the next slide, we are actually showing you what's called the yield curve, right? And we've talked about this a lot on the show. And that's looking at short-term yields versus long-term. Typically, long-term is going to be higher. That's a normal yield curve. Well, when it inverts, you get more on a short-term note. And in this example, the 2-year versus the 10-year. We just went through the longest inversion in history. The only time it went 700 days prior was 1929, Chip. I don't know if you remember what happened in the next couple of years. Wasn't real pretty. Well, we just went 789 days with an inverted yield curve that's uninverted. And again, we have a graph on the screen. Every time the yield curve inverts, every time 100% accurate. What happens shortly? You see the gray bars? Recessions, right? The economy is going to have to go through some pain, but recessions are normal. That's the problem, though, is the last 40 years, the Federal Reserve has tried to buy growth from the future and pull it in. So we've gone, if you take out COVID, we've gone 15 years with a pretty strong run in economy. What's also important is to understand long-term interest rates set their own rates. The bond market sets the rate. People are buying and selling bonds. So if you look at the chart we have now, we're showing you all the way back to 1980. So we're showing you a 45-year chart here of bond yields have been slowly coming down since that Paul Volcker stuff I mentioned earlier. Well, we broke out of that trend. Now, are rates going to go back up? Or are they going to still kind of stay sideways here? Or are they going to go back down? I can't tell you that for sure, but that's what we are watching. Critically important to tell us what's going to happen on how you should set up your allocation for risk adjustments, et cetera, going forward.
I'm going to give you a 1-minute warning here, David. What do you want to hit before we have to sign off?
All right, so let's quickly flip to debt. And I know I'm going fast here, but debt is what really is bothering me. So a year ago, we did our state of the market, and we've got on the screen, we had basically $34.1 trillion in debt. We did our state of the market this year. I put the same screenshot up there, $36.5 trillion. We gained $2.4 trillion in debt in a year where the economy supposedly grew, right? And so I think it's hogwash. In fact, we pulled up the jobs data. So if you can give me that job slide real quick here. This is the jobs. We had 131 million full-time employees in America right before COVID hit. Obviously, COVID rattled that number down, and we've taken, basically 5 years to get back, and now we're at 133.2 million. So we've added 1.5 million jobs net, right? That makes sense, everybody? But when you look in the numbers, how many of those were federal employees, Chip?
Yeah, the vast majority.
41%, over almost 600,000 or so. And so now you're seeing job cuts come in via DOGE. Well, the government employs basically 3.8 million people, and this includes the military, et cetera. And on the screen, that's the green. But you're going to see the blue get cut by 30% or so. And that's the 2.1 civil service workers. That's the reality. But where the job cuts are going to extend is on the yellow, on the graph we're showing right now from John Burns Research, you can see there's over 7 million employees that work either through contracts or grants that are directly paid from the federal government. Well, the yellow there, which is 5 million jobs, those are going to get slashed by more than half over the next 2 to 3 years. So all those jobs are going to go away, and that does not lead well to economic growth, especially if somebody says we should raise taxes at the end of this year. I know we've run long here, but look,
Good stuff.
You've got to pay attention to what's going on. If your advisor's not, maybe you should seek counsel from someone else.
That'll do it for this week. Please visit our website, retiresmartnow.com, and click Attend an Event at the top of the page to see everything we currently offer. No charge, no obligation for our events, but you do need to register. You can do it online or by calling 402-369-7777. David, bring us home.
Hey, have a blessed and prosperous week. Enjoy the spring weather while it lasts.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week.